Welcome to Leaders in Lending. I'm your host, Jeff Keltner. This week's episode features my conversation with David Reiling, the CEO of Sunrise Banks. We delved into a lot of topics. I know that's delve or dive, but we did both. We talked about liquidity and interest rate risk, kind of how you think about managing through those environments. Talked a lot about Sunrise's focus on FinTech partnerships, how you think about finding the right partners, managing those partnerships for ultimate success through the cycle, through the whole kind of life cycle of the environment. We also talked about cybersecurity and what community banks ought to be thinking about when it comes to dealing with the emerging and evolving threats around cybersecurity. And lastly, they really dove into a little bit of what I thought was a really interesting topic around what creates franchise value for a bank historically, what creates it today, and how you think about really being the most valuable bank you can be and leveraging the assets you have to do that. So I think it's a really fascinating conversation. I hope you enjoy it as much as I did. This is my conversation with David Reiling of Sunrise Bank. David, thanks for making the time to join us on the podcast today. I really appreciate it.
Jeff, great to be with you.
So I'm looking forward to this conversation. We got a couple of topics, and maybe we'll go off topic a little bit too.
Perfect.
But let me just start with, how did you get into the banking financial services space? I always like to ask people this question because I feel like it's not the childhood dreamed career path. And I'm kind of curious what the route people took to bring them to this place.
Dude, I was born a banker right out of the womb. I had a suit and a tie on. No.
Love it.
So honestly, I was a teller one summer and I loved being a teller. Now, every other summer I worked construction. So there was maybe a little air conditioning might have played a little bit of a role in that. But I enjoyed being a teller, the cash, and it just so happens the bank I was in got robbed twice that summer, which I thought was super exciting. In any event, went on to college. I started a business in college, built it up, sold it. But once I sold it, I thought I was going to be a banker based on my, 2.5 month experience. And so I became a trainee in a bank. And lo and behold, the first 2 weeks I was on the job in this particular bank in Los Angeles, it got robbed 3 times. And so I thought this was just normal for banks. Long story short, I quickly got sent to South Central Los Angeles because I seemed to be comfortable in a bank robbery, and of which the time was the bank robbery capital world. And so I've seen my fair share of not only bank robberies, but gangs and drugs and cops and riots and Rodney King in the day. So very much an urban experience there. But I would tell you, the third time I had a gun to my head, I didn't think my luck would hold. So I went on to work in downtown Los Angeles for Citibank for a while. I had a great experience there as well. And my father called me and said, "Hey, there's a bank for sale where you grew up in St. Paul. It's about to fail. You should come take a look at it." And so we bought that bank, and he's my minority shareholder to this day.
I got to say, do you keep comfortable in a bank robbery in your LinkedIn on your skill? Like, I haven't seen that skill on the LinkedIn list of skills, but I feel like you ought to. Cool under pressure doesn't quite cover the have been through multiple bank robberies of that.
No, it's not the lead on the profile on LinkedIn, but it is a characteristic that I do possess. So maybe I should drive an ambulance or something. I don't know. Maybe I'm built for something else.
I got to say, I've had a lot of people who started off as tellers, but I never had a bank robbery story in the intro to the podcast. So I've already brought diversity to our story base. Let me just start with this. What are the kind of key topics you see on the minds of community bankers right now? It's a pretty wild time, to be honest, in the world in general, but in banking in particular. What are the things you see that are top of mind for folks these days?
There are a whole host of them, Jeff. I mean, the laundry list is long, but I would say, some of the critical ones, there's just a general sense of anxiety given the bank failures of SVB and First Republic and Signature and so forth. And so there's a bit of just unease there. And that I would say is predicated on liquidity, right? How much liquidity does a bank have? Can it keep lending? Really important to the lifeblood and growth of a bank. And so in addition to that, there's going to be some credit quality issues as, the talk of recession and interest rates are higher. And so all those are various topics. Then, one thing community bankers really, I say, are not very well equipped for is, do they really have their cybersecurity tight and in check? And that is always, it's a battle for any business, bank or otherwise, but it's always in the back of your mind as, are we safe enough? Are we doing enough? And obviously the regulators are in there making sure that banks are safe and sound and protected, but there's always that worry of that type of an attack. So a lot of issues on the forefront of a bank these days. Particularly, I'd say maybe one, if you're a bank owner, has a different perspective, is what does this franchise value look like? And how big does a bank need to be sustainable long term, as opposed to just a lifestyle business? And it seems, in these days, being in the middle, if you're not the largest and if you're not the smallest, that middle is a little risky as well, as we've seen.
Interesting. Well, let's tackle these maybe one at a time. What are you seeing people do about the liquidity issue? I mean, it's such a striking contrast to me because if you came to me 18 months ago and said, what's the most common thing you hear from a banker? I go, too much cash, not enough loans. That's the most common thing I hear from a banker. It's like the exact opposite of what I hear today. So what are you seeing as the response to that from the community banks or other banks? Like, how do you deal with what is a very real liquidity crunch that can turn quickly into bigger issues for the bank, as we've seen? I mean, bank runs driving some of the issues at SVB or First Republic, not just the kind of deposit run, but that liquidity issue certainly front and center. What are people doing to respond to that?
Yeah, I think the biggest response is that they're being more cautious with their lending. And so maybe the impact of what the Fed is doing and so forth and the recent bank failures have really put a slowdown or cooling in regards to the amount of lending that banks are looking to do. So in regards to liquidity and protecting the liquidity that they have, they may only lend to their existing customers, or they'll only selectively take on new customers in order to protect their existing book of business and kind of ride this out. But I would say, there's maybe two things to kind of glean from the recent bank failures and so forth. And that is, one is when you look at your typical community bank, I don't think there's going to be a run on any of those deposits for your institutions, let's say below 10 billion. I mean, we know a lot of the customers, we reach out to them. If there's anything maybe we learned in the Great Recession is diversify your deposit base as well as your loan book of business, right? You can't just be concentrated in, let's say, construction lending or something. So, but now there's a focus as to, can we keep and maintain and retain our existing liquidity? Can we grow it in certain areas, and can we diversify it? And so all that, I think, pertains to different particular strategies. And in some cases, if you're stuck and if you're a small bank in a small community, you don't have a lot of options. I mean, you can go online, but that opens up a whole nother plethora of kind of risks in terms of gathering liquidity. But diversification is definitely forefront in terms of the quality of liquidity.
Yeah, it's interesting. I do think it's an interesting question for the community bank because they do have limited, but I would say the online deposits are also the scariest to me because they are the least stable, most likely, and the most price sensitive. So, if you're trying to restrict lending for liquidity, but also fighting a battle to maintain deposits that are very rate sensitive, as many online. I mean, people are going savings account to savings account, going, who's got an extra 25 bips for me on my money? Like, that's you can't take that money and then not lend it. That's a great way to go bankrupt. If you're taking that money at 4 or 5% and then sitting on it as cash and not putting it out the door at a higher yield, like that's not a good business model.
No. And on top of that, if you're a smaller bank, your customers might be moving to a large institution, right? Because they perceive they're going to maybe they don't want 6 different bank accounts with 250,000 in it or something of that nature. They're just going to go to a too big to fail bank and make it happen.
And put it all in there. When you talk about the restriction in lending, do you see that shifting? I mean, like as we near what most people think is something like the end of the interest rates rising, it feels like the interest rate risk that really hit some of the recent bank failures hard is on the other end. I mean, you're unlikely to originate assets today that are going to be worth substantially less, assuming they perform in a year or two than they are today, because interest rates are probably not going a whole heck of a lot higher. They're certainly not going 500 basis points higher. They're probably coming down. Are you seeing as we start to see some signs of a positive motion in the economy and maybe the nearing of the interest rates hike, some opening up of that lending or changing of strategies on that front?
Yeah, except that I banks are generally slow learners, and so and they're slow movers. This is not the entrepreneurial community, and so the fact is that they're slow to this game. So they were slow to raise deposit rates, and they're getting there quickly, obviously to protect their liquidity. Now they're going to take a pause. Now, the one thing that I would suggest, which I do to all bankers, but bankers should know this: you don't bet on interest rates going up or down. You're going to manage your portfolio within a certain bandwidth. So you're not you may not be gaining everything you can gain in an up or down market, but you're not going to lose everything in an up or down market. So you need to be prudent in terms of how you manage that. And maybe SVB is a great example of not doing that well. And that's just fundamental asset liability management, and protect your up and downside, and don't bet the charter on you predicting interest rates, because obviously you can be wrong. And given the way the world is today, somebody lobs a bomb over somebody's border, the game changes overnight. And so while we think we're at the top of the rate cycle, and I would agree with you from a momentum standpoint, we're getting there, I wouldn't bet everything on it.
No, I wouldn't bet everything on anything. That's not the not smart, not the way I play the game anyway. Interesting. I want to hop to your second topic, with this topic of cybersecurity. You talked about top of mind and the investment. I'm curious, what are the trends you see? What are people doing? It certainly is, I think, one of the hardest problems, because it's an evolving landscape. It's not, bank robberies occurred in a certain way, but cybersecurity theft tend to shift approaches much, much more rapidly. And I'm curious how you see people dealing with that, and what the trends on the horizon are.
Yeah, I think some of the big trends in banking and community banking particularly is, if you're going to look at your core system, are you moving into the cloud? That's going to be one thing. Do you have the right core system to start with to meet your needs? And are you moving into the cloud? So just as a basic of what that might mean for someone, and that is, so over, let's say, the course of a bank's history. And so our Sunrise is like this, right? We've got applications and things layered on top of applications built up over 30 years. You don't want to patch all of that. You really need to start narrowing everything down. You need to simplify and get robust, but also you need to automate your patching and your vulnerabilities that are coming out, weekly. So you really need to stay at you not only have to address everything that you have, right, and get a steady state, then you just got to maintain it. So every Tuesday, it's, patch Tuesday or release Tuesday, I don't know what they call it in the IT world. You got to be able to sustain whatever that number is, and you don't know what it is from week to week. So there's definitely a pulse to this, and it requires you being on top of it, because obviously the hackers, the bad guys, whether it's a government or whether it's some other organized group, they're getting better and better. So making sure that not only from an infrastructure standpoint you're there, but the hardest part is your people, right? What's coming in on your email server every day? What are people clicking on? I have to tell you, our IT department have become masters at testing us in terms of phishing. So every email, I am brainwashed. Every email I'm suspect of. And so, but that's the psychology you need to have. It's a bit like a bank robbery, to go back. If every morning you go to the bank and the procedures that you follow to get into the bank safely, if you think there's going to be a bank robbery and you practice that, you're good at it, right? Because your awareness is there. And so that's the type of culture that you need to have, I think, in a bank these days in order to really protect the institution. So you need the hard stuff, but you also need the soft and the people to be good. That's challenging.
It is, Sean. I want to go back, because you said at the beginning, ask yourself the question, are you in the cloud? How do you see the cloud relating to this question of cybersecurity? Is that something you see as an advantage, a disadvantage, something you recommend doing? Like you brought that up, but I didn't really get to the end of your thought on what the pros, cons, the thoughts around the cloud and how it relates to cybersecurity are.
Yeah, I would say the one thing that I probably should say is, as you go to the cloud, you're really going to look at all your applications that you're going to put up there, right? You're going to scrub everything that you're using today, even if it's something fairly simple. You're going to need to do some risk assessment on it. So you're just at this place and space that you're like, particularly if you're a bank in the fintech, or let's just say in the consumer lending space, these are programs that have scale to them. So you're going to want to be able to scale up your capacity, as well as you're going to need the sophistication in terms of the data mining you're going to want. So you do need, in my opinion, the economics and capabilities of being in the cloud. So you have the capacity to do large volumes of business, but then you also have the ability to manage and oversee the security around that. So I think there's a multiple facet to cloud computing, as well as we were a bank that hosted our data center on-prem. And so now we're exiting that business. We should not be in that business. There's better places that are more economical and safer to do it.
Interesting. Yeah, I think this shift to the cloud is, to your point about one of the benefits of the cloud or outsourcing and stuff like that is it's just like um, that Patch Tuesday becomes somebody else's job. It's somebody who's doing it for lots of institutions, somebody who's doing it at scale. To your point, people who are kind of expert um, in that particular skill. That's a pretty valuable capacity for you to free up your resource for the other things that you need to focus on. Can I ask you one other topic I'm really curious about, which is, I've been following the emergence of these generative AI tools. I think it's a really fascinating time. I'm in the AI space a little bit, so I just every day I'm on 5 newsletters, and I've never seen a pace of innovation like this. And recently, one of the kind of originators of the neural network left Google, and said he wanted to speak more freely about the risks. And his most immediate risk is not one of these existentials. It's the ability to have much more realistic misinformation, false information, kind of lying about things online in a very convincing way. And it occurs to me that things like synthetic identity fraud, how we fool people into social engineering kinds of issues become really possible at a scalable way, in a very scary way with these. And I'm curious if that's something you've seen, because it's a little different than the traditional cybersecurity threat, right? It's a little bit more in the social engineering, either synthetic identity fraud or first person fraud, where I've got somebody who's being fooled into taking some action that they're not intending to take with their bank account and wire money to the Nigerian prince or whatever it always is that's going to give you your nice return. But are you seeing any emergence as these tools, or is that something you're watching? Because it feels like the capabilities of those tools have evolved so rapidly. And now I'm going, well, where is it going to pop its head up and be a danger or a risk? And how do I think about dealing with that?
Yeah, it's a great question. And it's a real threat. And so I would say Sunrise, particularly, since we are a bank to fintechs and act as banking as a service, if you will, in a lot of regards. So we do have obviously protocols and procedures and so forth, in which you're going to either you're going to try to affirm the identity of somebody, right? And so that is not only at the origination time when somebody actually gets an account or gets a loan, but then looking at the characteristics afterwards. So are you monitoring alerts? Is the activity in the account typical of this, or is it outside? What are your alerts telling us? Are you refining your alerts? In the case of, I'm coming online to do a business account. Well, great. Why do you have all these microtransactions? That's atypical. And so you need the help of other AI tools and so forth in which to alert you to abnormal behavior that you can, if you miss it on the very front end, if you get fooled by the social engineering, if you will, that you can identify characteristics that are not common in an account like that. And so there's multiple lines of defense, I think, when it comes to the synthetic identities. And we're going to have to get better at identifying them. And so there's going to have to be, that multi-factor authentication is going to have to become more and more robust, may have to be biometric in some cases. It's going to be different. And I think that we're going to have to implement some of these new tools quickly, because once you open the door and something works, it will be exploited significantly and quickly.
Interesting. And how do you think, as a bank that supports fintechs, how does that, you think, change your risk profile? Because you've got kind of different brands, different acquisition sources, different partners doing different things. How do you think about how that changes? I mean, in some ways, you're maybe more cognizant of it, but also more at risk in differing ways than maybe a more traditional bank that doesn't have those kind of partnerships. How do you think about managing that risk as it comes not just in the customers with a direct relationship with your institution, but those coming through some of the fintech partnerships you have?
Yeah, the way that we think about it is really from the very beginning of the relationship that you're looking to develop with a particular fintech, if you will. Are we values aligned? Are we trying to be a hero to the same consumer? Let's say, is our goal to provide some value and have the return to be reasonable? It's not just extraction of value. I think coming at things at the very beginning of what is good for the consumer or the ultimate user of the product is a very intentional type of screening that we're going to look for at the beginning. It's really kind of a values-based screening. It really leads into the next, I would say, big filter as we take a look at our risk, and that is, how does that particular fintech think about compliance? I mean, I can give you some examples of whether it's Blue Ridge or most recently Cross River. There are others that are likely to find out soon that are under regulatory restrictions or compliance restrictions. So compliance will win the day in the long term of a partnership, but it also, that compliance mindset not only needs to be at the bank, it needs to be in the fintech partner, and the two teams have to work together. It's not, if it's a competitive relationship about every little detail, that's not going to work. The idea is to run a safe and secure product or financial service or offering. And in that particular space, you have a sustainable business as a result. And so I do think compliance is one of the aspects where the intentionality and integration of it between the two partnerships ultimately is the long-term benefit. And it may seem like it's a bit more from a financial burden up front, but the long-term tail certainly pays off because you'll win the day. You'll be the one in the marketplace, and you'll have a business that is sustainable.
Got it. Like it. So if you were going to give advice to any bank looking at fintech partnerships and being effective in that space outside of the compliance is key, how do you think about, finding the right partners, finding that alignment? Like, how do you measure that thing? That feels like the kind of thing that people, it's like the thing when I ask my kids, the question, they know the answer, they know what I want to hear. That may not be the truthful answer, but I hear it anyway. And then you got to figure out how do I really understand if I'm comfortable with that answer, if I believe what's being said there, or if I want to ask the questions. How do you think about finding the right partners and managing through that challenge in your space?
Yeah, the advice I would give is that it seems like, I'll put it this way. Everything up until right now in this moment was just practice. It was just practice for what's going to come at you tomorrow. You might get the greatest opportunity, or you may find one of your partners did something horribly wrong, and you're going to have to adapt and adjust, and you're going to learn. And so every day is game day, but it's a learning day in which to take it to the next one to say what opportunities and what threats are being presented to me. And I think of Sunrise as an opportunistic bank that wants to do good. So we're looking for people that obviously share the value component. We're also looking for ones that have an abundant mindset, that want to scale and have the ability to do that really well. That is just a great combination for us. That is when we dive in all in, because we know that there's kind of a win-win-win scenario to be had here. And it's going to be sustainable from the regulatory side, from the financial side, and you're going to have great stories to tell about consumer or customer impact. And as a result, you got a good gig.
All right. So one more question on this topic, which is, you earlier described banks as not the most entrepreneurial, fast-moving cultures. And then you gave me an answer right here that's like every day is a learning day. So how do you think about shifting, or at least building a culture that is accepting of that in an industry where typically, there's a little bit more of the, hey, we can go slow as long as we get it right. And there's here, I think, a little balance. Like, we need to learn how to do it right, but also move quickly and to adapt and to learn and adjust on the fly. And I feel like that's culturally different than most of these financial institutions are used to operating. And I'm curious how you build a culture, a set of incentives that empower people to do that. Because it doesn't feel like the natural outcome for an institution, for a bank, for a credit union to behave that way. And yet I think you're right that it's probably critical for the future that they learn to do it.
So you are correct. And so you're taking bankers who, yes, I think the profile of being more conservative and slow and careful and deliberate and wanting to be right over taking some risk. I don't think that luxury exists really anymore from a strategic risk standpoint. And I would tell you that the regulators are very focused on smaller community banks as to what is your strategic plan, because the plan of not doing anything isn't a plan. That's a plan to either go out of business or to ultimately sell the organization, and maybe not at its highest value. And so as a result of this, bankers are going to need to think more progressively and entrepreneurial, and they're going to have to, quite frankly, the person sitting in the leadership chair, as well as the leadership team, including the board of directors, and we can talk about that dynamic, they have got to encourage and live that entrepreneurial, the ability to take risk, the right risk, the risk that you have an appetite for. Get rid of stuff that you don't, but you're going to need to take risk. You're going to need to experiment and invest in what your future is. If you don't do that, I just don't think you have a franchise anymore. You stop growing, and as a result, costs keep going up, compliance becomes more. You will not have the ability to sustain yourself. And obviously you're losing franchise value, whether you make some money a little bit or not. You really, whether that charter retains itself in time is very suspect. And so the world of banking has changed, the economics of it has changed, and so do bankers, and the way that they're managed and run. And I'll give you one tip where I've done some consulting work. Sometimes you have a management team that is very excited about trying new things, but you don't have a board of directors. That doesn't work. Sometimes you have a board of directors that's very excited about doing things, but you don't have a management team, and that doesn't go anywhere. Fact is you need both of those to run in parallel to change the culture of the bank, to hire the right people, to fire the wrong people, and move the organization forward. Not easy, but it's necessary.
It's necessary. I just want to follow up. You've used the phrase franchise value a few times, and I'm curious how you think about where a bank's franchise value derives from these days. I think we used to have a sense of like physical footprint of retail branches equaled coverage of some consumer base equaled some durable advantage, and that I think in the current world, like it's clearly not the not the model, right? It's not your branch footprint and how many people are within how many miles of a branch and all that. How do you think about what really drives the franchise value of a financial institution today? What is it somebody should be focused on to drive up their franchise value? Where does it really derive from?
It's probably as relevant today as it ever has been. We lost sight of this in the past number of years. But a huge portion of the franchise value of a bank is in the deposits. The deposits always sell at a premium. The loans always sell at a discount, right? You're going to look at your loan book and then people are going to go, that's a bad loan, that's a bad loan. They're going to pick things out or they're going to discount it. Now, the better quality of portfolio that you have on the loan side and investment side, the fewer the discounts. The higher the quality of your deposit portfolio, its diversification, its characteristics in terms of both stability and diversification and growth, that is a key. So if you take Sunrise, we have one of the component of our deposit portfolio is certainly local, but it's also in the payments business as well as FinTech. But let's just pick apart prepaid cards for a second. So I don't know, we have 50 million prepaid cards. Those are contractually in the bank, and they're in anywhere from $5 to maybe $500 on the high end, and there's millions and millions of them. Those deposits aren't going anywhere. So it's a very stable base. But it just adds to the diversification of the local deposits that we take in from businesses and consumers and so forth. And so again, different models in which to get that liquidity, but in that base, the franchise value, I think, is centered really on that. The next thing I think that we will see in the future in terms of franchise value is where you alluded to. Is there some type of IP that the bank has in terms of a business model? I think more and more, whether it's the use of AI in some type of way to assess credit risk or to move payments faster or more accurately, to identify someone, all of that, I think IP will become more and more of a component of the value of a bank.
Interesting. David, this has been a fascinating conversation. We've ranged a lot of different places. I got 3 questions I like to ask everybody at the end of the podcast. So I'm going to throw them to you now. The first one is, what's the best piece of career advice you've ever gotten?
The first one, show up. Just show up. If you show up, great things happen. I don't know what, personally, professionally, volunteer, you name it, show up, great things happen.
I love that advice. I'm reminded so often when I get good advice that the best advice isn't hard. It's just not easy. It's not complicated. It's not sophisticated. It's not difficult. It's just not easy to execute. It's simple yet challenging. And I think that's a good example of advice that is.
I mean, I'd have to tell you, my board would always question me. They're like, Dave, why are you going on so many trips? Like, why are you out in DC? Why are you in Chicago? Why are you in that? I'm like, I learn something every time in a trip. I meet new people every trip. Trips equal deals. And I go, it's not easy. I got to do the full-time job, but I also got to travel. But I'm telling you, show up, good things happen.
When you show up, good things happen. All right. Second question, what's the best advice you've ever gotten about the kind of consumer banking space in general?
I would have to say compliance wins the day. It really
wins the day.
If you have compliance programs, you will have a business model. If you don't, you really don't have a business. Compliance wins.
Compliance wins the day. A lot of chief compliance officers cheering that answer.
You're welcome. Compliance is sexy at Sunrise, so it's kind of fun. Anyway.
Well, but I think it speaks to the desire. That's an interesting comment, because I think if compliance wins the day, then there's a lot of advantage in being good at compliance, making compliance. I remember when I was first getting into my career, somebody told me I was a technologist, and they said, "You want to be in a technology business," and this guy wasn't, but he kind of said, "When you're not, you're a cost center, and when you are, you're a profit center, and you want to be on the value add side, not the hurdles and costs side of the business." And I think very often compliance is seen on the hurdles and cost side. And if you can turn it into a value side, make compliance sexy, something that's like a value add for the business, it's a very different way to think about it. But if you think compliance wins the day in the end, then it's a pretty strategic thing for you to do as an institution to turn compliance into that kind of function.
Yeah, one acid test for that is: do you bring your compliance team to the sales process? Because a lot of the hardest questions are going to be around compliance with the partner sitting across from you. And if your compliance team can answer it accurately with potential solutions, then it's a big key to selling. It's a big key to the sale, because generally it's seen as that obstacle, but you can see those options and pathways to do things compliantly, but get it done. That's the key.
Love it. And my last question: what's one bold prediction for the future, so we can bring you back and compare notes on how this one turned out?
Fantastic. My bold prediction for the future is I think AI is going to be awesome for good. I think people there's so much focus on the negative. I see so much opportunity for AI to do great things from an inclusionary standpoint, providing access to credit where it wasn't before, marginalized groups getting into the financial institution, helping people save, avoid predatory products. I think AI for good is way underrated. I think it's going to be fantastic.
All right. That's a nice optimistic note to end it on. David, thanks for joining us today. I really appreciate you making the time.